in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast number 187. This edition of the Moving Iron Podcast is brought to you by Dawson Tire and Wheel, your premier ag tire and wheel provider in North America, helping people grow. Tractorzoom, delivering insights, and Dryshod Boots, the official work boot of the Moving Iron Podcast. It's this week, lucky to have Rich Posson pop back in and talk about what he sees happening out in the economy. And it's always a pleasure to have him on. Rich, how you doing, bud?
Good.
Good deal, man. Well, plenty of stuff to talk about. There's all kinds of things going on all over the place. I think what I want to start with first is start with a little bit of the U.S. economy here and what we see happening. There's been a few governors that ran out real quick and opened back up some economies, and now they're Florida and Texas and areas like that, where now they're starting to see a kind of a climb back again of the coronavirus cases that are popping up, but they're popping up in a completely different segment than what we saw the first time around, and there's not been as many hospitalizations, I guess, is probably what the word I would use there, as kind of as we see things move forward. I guess looking at the economy now from 60 days ago, Rich, what do you see happening, and kind of what are some of your models showing you right now?
Yeah, I'm back in March, I called a bottom in the stock market, but I said, we could be at least 6 months away for a bottom in the economy, and worked well in the stock market, called the bottom within 2 days, and boy, some of those trades related to that are up like 40 to 60%, so I'm very pleased at how that all worked, especially when the stock market is still down on the S&P 500 for the year. But on the economy, about a month ago, I called some bottoms and a few indicators for the economy. But all those indicators suggest is the pace of decline, erosion in this country is just slowing. So it's warning the economy is now getting close to bottoming out. But the models are showing that things like the stock market and some of these indicators could just zigzag up and down all the way in the next year. And for the stock market, it's even got a slightly lower bias to it, and it just concerns me that the stock market is just too optimistic of winning on this virus thing and the economy coming back. Some people have just been damaged and business going bankrupt, and every day I'm hearing, well, the bankruptcy number projection is raised again and again, and I'm thinking, it's not going to be a V bottom where, it was a terrible time for a few months, and within a few months everything was grand and we just go on our way. I think this is going to take quite a while, and for the very long-term stuff for several years now, or ever since 2015, I said, we should have an economic problem here, 2018 to 2021, so 2021's the deadline year to put a bottom in for the economy and fix it, and I can see the same thing in the global economies. It's just not there for a robust turnaround. I think it's going to take quite a while. And I even saw some statistics over the weekend here where some think that there's going to be nearly 30 million more homeless people just because they can't pay their rent, they can't pay their mortgages or whatever. So there could be some very discouraging news coming down the road here at us, and I don't think the stock market fully appreciates that. Maybe it just doesn't care. I think they can focus on, hey, as long as somebody's working and the lights are on, well, then that's good, But you can just see that this could take quite a while to work out of this, and it's got me nervous with this virus coming back, which you can argue it never left in the sense that we're still in the first wave. Others are saying, no, it backed off, and now it's surged, so now you're in your second wave. But I don't know. I think this may well be just the first wave, and the true second wave may be a few months more down the road. So it's really got me concerned as I see the cases blowing up in Florida and Texas. And I recall about a month to 2 months ago, someone in Florida tweeted how Florida was doing so much better and their governor was so much better than the New York governor. And I thought, oh, man, you're not comparing that properly. And I was so close to just tweeting and telling them how they had to rethink. No, I didn't. I let it go. And then here we are today. The virus is, that's now New York is looking so much better than Florida.
Yeah.
It's just blowing up out. And, and then you can also compare the southern states to the northern states, and there's a map that actually says, okay, warmer states, colder states. Because in the beginning of this, back in February, March, the discussion was, well, it's actually a cold virus. It doesn't like the warmth. Well, there's no evidence of that today because the whole country's been knocking out some records here at times, and the virus is doing even better. And so some people are already saying, well, it's already adjusted, and that's what I've been hearing all along is this particular virus is just very good at adapting. And then, of course, opening the economy, yes, I think everyone in the country assumed, well, you're going to fire up the virus again. We're going to have more cases, but we'll get through this. That's just a natural thing. But boy, you look at the surge of this, though, and you're wondering, did we just make a grand mistake here of moving way too fast? And that's what the health officials are concerned, is that's exactly what's happened. And so some are already backing off. California is shutting down bars and various types of stores, and Apple has shut down all their stores in California, I think. Texas is doing the same thing now. I don't recall in Florida, but there's several states saying, well, we're probably going to have to shut things back again. So, again, I'm convinced that these markets really aren't fully appreciating this lingering problem here. And we can have a rough economy for months yet. I think it's going to bottom the first quarter of next year, but I'll just play it safe and say all these years, the model said the latest for bottom is 2021, and I should leave it at that. But, I think it's going to be a tough struggle. And even though I've been right on the stock market, I kind of feel like I shouldn't have been that right. I shouldn't have been that profitable. I can't explain I'm being that bullish. I'm just glad the model is on top of it and kept me in there and kept me on the right track because, there's some big players out there, billionaire-type traders who some of them even retired. They totally blew it on the way down and they blew it on the way up, and they just said, we haven't seen anything like this in our lifetime. Getting too old, time to quit. And it just goes to show you, if you feel like some days you just can't invest and compete with the big boys, you can do pretty good with the right methods and just a couple of computers versus those that have 100 computers and 50 analysts and $10 billion. It's so moving forward on the economy, or let's put it this way: the government, or I should say, the Federal Reserve, has, of course, pumped in a lot of money, but the Treasury has printed money. The government's basically printing money or taking the money from Treasury and Fed and pumping it out there. And I just saw some numbers here on the M2 money supply. And back in 1980, the supply of that type of money was $2 trillion. In 1980, as of March, it was $15.6 trillion. And then just from March into May, it jumped to $18.4 trillion. So if you look at a chart, it's just exploding. It's the highest on record going back to 1980. So just a huge amount of money supply. Well, you then go over on the personal savings side, which I'm kind of baffled in the sense that for so many people losing their jobs, and yes, they're getting unemployment better than they would normally get for unemployment. Some of them are doing better than if they were still on the job. Same time, I would think at least the poor and the lower to mid-middle class really wouldn't have money to pump into savings at all. They're probably spending savings. And at any rate, personal savings were 7.9% in January. That was the rate of how much they're saving. Jumped to 32% in April. And the last record was in 1975 to 17%. So almost double the record here in the matter of a couple of months. And that record goes all the way back to 1960. So there's a large amount of money out there that, yes, someday is going to come into buying homes, rebuilding businesses. It's going to come back into the stock market, and that's probably what some people are buying the stock market now, hoping to stay ahead of everybody else, and they're just in greed mode. But it also shows the shock to our economy right now. And I think people are thinking, how large of a home do I really want? How fancy of a truck or car do I want? I think we're going to change our consumer attitude here for the next 12 months. Some think it's going to change it for several years. Well, I'm not so sure about that. American people are amazing that they can get over the bad times pretty quick and forget about it pretty quick. But I'm willing to say there's a lot of people out there that as they get back to work, they're just not going to spend as much as they did.
Yep.
They're going to be concerned of the future. They're going to be wondering, is this virus coming back? Is it going to hit my family? Is it going to hit me again? Is it going to hit the country? I'm going to lose my job again. And that's why I think we've got a slow haul here to improve the economy, which is what's making me also nervous in the stock market since it has been so profitable. But
Yeah.
I think they're ahead of themselves. They're not looking that clever, in my opinion.
Right.
But granted, looking out 4, 5, 7 years and stuff, we'll work through this. And I must say, I did some research of saying there's been an old thought that normally the economy and stock market will do pretty good the year before an election, and they assume nobody wants to rock the boat, cause any problems for anybody, and you got to get the election out of the way. I must say, when you can get an election near the times of these major long-term business cycle tops, when it's time for recession, it is interesting how the recession can shove off to the year after. It's almost like nobody really wants to become too depressed or too bearish, too negative, pull back too much, and they kind of wait. Well, of course, the virus come in this time and made everything so much severe than anybody was imagining. So I doubt we're going to get it like a post-election slump, but we very well could, that there could be something else going on there. But what fascinated me more was around the time of election, when you can see the first 4 years of that major long-term cycle turning up, that 100% of the time since 1930s, the stock market was higher and the economy was already record large and doing well. What this tells me is since that the Republicans and Democrats, in terms of being in the White House and even in Congress, they really take turns. It's about 50-50. It's like there is no trend of since 1930s that it was mostly Democrat or mostly Republican. It's like everybody just takes turns and it just kind of negates one another. It's all equal. And yet was weird. So what that tells me is during that 4 years that everything did so well, it didn't matter who was in the White House, didn't matter who was running Congress. And I fully understand that. Some people say they don't get it because they assume politics are so important and government policy is so important. But you have to remember 80% of our economy or more is consumers and businesses, and most of that is consumers. So what it's telling me is the consumer and business people, for that first 4 years, whoever's getting elected, they're going to be optimistic. They're going to be business no matter who gets elected. Now, you can make an argument that the economy doesn't do as well maybe under one type of president because people just didn't like it. Okay,
Right.
So, but to me, the whole political thing doesn't make or destroy the country or the economy. All it does is add to or take away. So I can't tell you who gets elected and how good things are going to be in the next 4 years. What I am telling you, it doesn't matter who's going to get elected. Time is going to move forward. Things are going to be better 4 years out. How good? I don't know yet. We got a long ways to go for that. But it does tell me we will get through this and it'll be okay. But I am telling you, we could have some problems all the way in the next year. And I realize right at the moment the commodity side is saying, well, our prices are already low and it doesn't look like the economy is hurting us any. And yes, majority of the population's living and they're getting some food somehow and this and that. And so it's really kind of creating a floor price in commodities. But the key is if the economy's not going to get better for another 12 months, to me, it limits how much upside you can have, even if you have a little bit of a supply problem in these commodities. And so even if we get just a little bit of a crop problem, I don't think it's going to have the upside it once did. Now, if you get a major crop problem, that's a different story. We could still have a sizable up move. Something else I want to point out in the economy is all this money printing is certainly changing some attitudes of some people in terms of inflation. And many years ago, by the time we get somewhere in those late 2010s, early 2020s, we ought to see some kind of a bottom inflation and interest rates. And for inflation, I thought it might come in as early as 2008, 2009 off of that financial crisis that put a bottom in there. And the thing is, though, this past week, especially this weekend, I saw several articles of various billionaire-type hedge fund managers, some major analytical firms, some of them kind of private and small, but very well respected, a big following. Others, such as major banks like Society General, one of their analysts just come out over the weekend. And this particular group of analysts really were thinking disinflation, deflation, nothing would get more expensive for at least another 10 years, maybe 20, and interest rates would remain dirt cheap. And So they were also bullish the stock market, saying you never will stop the market. It'll just keep going up because it's the only place to put your money. And it's interesting how many were in these articles here in the past 2 to 7 days here of changing their mind, just totally trashing their 10, 20-year forecast. I mean, they just dumped them and saying, we've just printed way too much money and we're going to get inflation. Now, the thing is, it seems like no one knows just what path are we taking for this inflation. Is it going to start immediately and just keep on going? And I think some feel like you're going to get a shock in just the next 2 to 3 years. One of them even said 4% inflation by 2021. And right today, we're probably at 0% with the economic recession. So, or at least no more than 1 or something like that. And I forget the number the US, or Fed is following. But that's a big jump to have in that short period of time. And
okay,
from my, yeah.
What's that? Okay, so let's put that in perspective. Because you're answering my next question. I was going to ask you about interest rates. What's that look like? Because I agree. I mean, they've pumped $6 trillion out in this coronavirus stimulus package, and plus every other thing they've done up to this point. There's a ton of money out there. I mean, so if you're analysts that you're reading saying, we're at 0% now and we're going to go up to 4%, give me an idea what that looks like for interest rates. Like right now, I think you can get a 30-year fixed mortgage for like 2.875 or something like that percent interest. That's hardly anything. We're throwing around 0.75% interest.
That's the tricky thing. If we had inflation for the past couple of years and then suddenly get a jump, I would say interest rates are going to increase by 50% fairly soon. Since we've had such a low inflation and low interest rate environment and the economic recession, and even investors are not buying bank stocks, they're just concerned of the future. I doubt interest rates would immediately move by a huge amount, but they should move up. And I do think we're putting in a super cycle of interest rates. If it doesn't occur, it may occur as soon as this month even.
Yeah.
I haven't seen the evidence of it yet. I'm not calling it. But it should also bottom no later than next year, right along with the economy and what I'm seeing inflation. I think for me, if I kind of feel like 10 years from now, or even, it may even take 15, 20 years, we could see something like 5% inflation, 6% inflation. I would anticipate interest rates of 4 to 6%, and I'm talking the 10-year note that is zero. It's under zero, or I'm sorry, 0.7%. So, to make a move, we're talking 4 or 5 times what the current rate is today. But I think in terms of people think back in 1980 when we had inflation of 10, 12%, interest rates hit 17, 20%, something like that. I'm not seeing that, and this type of cyclical trend that I'm using is saying any real high interest rate and higher inflation is probably 15 to 25 years away, and then that should be your highest, and then we're going to start to cycle all over again, start working rates lower. So to hear someone say 4% in a matter of just a year or two, I don't think you're going to take the 10-year note to 4% from 0.7, and if so, it's going to clobber the economy. That's why I just don't think things can work out that way. So I think it'll be a heck of a lag compared to to that. But nevertheless, if you take a mortgage rate of, say, 3.5%, and you're going to pump inflation to 4%, I would say that's going to put the 30-year back to 4.5%. Uh-huh. But the thing is, the longer this takes, pretty soon just going from 4% to 5% might make an exponential move in that interest rate, and suddenly you're at 6%. So you're going to get the higher the interest rate, pretty soon higher the inflation, the interest rate is going to start out slowly lagging, and then it's just going to start speeding up. And when you start getting into that late inflation cycle, then you can actually see interest rates moving higher, especially if the Fed decides to kill inflation, then they'll actually force the interest rates higher, just like Paul Volcker did in 1980.
Right. So you're saying there could be a point in the near future that could be some like a catalyst that could send the market into a bit of a I don't know, hyperinflation is not the word to use, but Something along those lines.
Hyperinflation would come in towards the end of it. As far as the process, even though I'm against this analyst saying 4% in 2021, I don't see that kind of shock, but I fully see these hedge funds, some of them that I didn't think I'd ever seen in my lifetime, bet on inflation ever again. And here they're changing their tune, and they're starting to use a little dab at Bitcoin. Like one of them says he's only going to have 1% of his portfolio in Bitcoin, but it's an inflationary hedge. And then he's going to have a few more percent in gold. Like he's been a gold guy for many years anyways. So he's got a fair amount of gold there as inflation hedge too. And so you can see it. People have woke up that, hey, we're looking at one of the bigger changes in our lifetime of flipping back to what we haven't seen in 30 years. Okay. And so I feel it feels like some just do expect a sudden surge here in a very short period of time. And all I can say, if it occurs, it's going to correct by 50% quickly. And because they'll just throw the economy into reverse, and next thing you know, you bring your inflation back down, you bring your interest rates back down, and then you might get another surge. And we could have several surges over the next 15, 25 years, and it's kind of like walking up a stairs. You snap it up, you bring it down some, you snap it up again. And so for the really high interest rates, I think they're a long ways off. Now, I can't guarantee it. Maybe something I don't understand, that you can just have a huge explosion, and then it comes all the way back down, and then later it goes back up again to prove me right way out. But I would think, I don't know what would cause that right now to have a gigantic surge in inflation and interest rates. It'd be like the asteroid have to hit the planet, I think.
Right.
But the point is, you can get these little surges here that can upset people. First some will be happy and they made some money out of it, and then pretty soon they'll go say, but wait a minute, this higher interest rate now costs my business, it costs people, it's going to hurt the economy, and then everybody goes the other way. And I'm sure the Fed's going to be very careful how to do it, and it's a real tricky thing. I know some people just hate the Fed, and they think the Fed screws up every time, but it's a real tricky way of managing things and trying to make sure you raise interest rates enough to keep up with the growing economy, inflation, get them high enough to give it a cushion the next time you have a recession, and yet not raise them too much to scare people. And frankly, I look at today's interest rates and I'm saying, well, who cares if it goes from 0 to 4%? That means nothing to me, because I'm old enough to still remember the 8 to 12 to 17% interest rates.
Right.
But the point is, when your business is fine-tuned everything, and man, Wall Street is so fine-tuned, they worry about 1/100%, if you stop thinking about, okay, well, gee whiz, if you just went from 1% to 4%, my gosh, 300% increase in interest rates, when really it's still just 4%. Doesn't sound that much to me. But the point is, it means a lot to someone, right? And so you can get these shocks where it really doesn't take as much as it should to cause a problem with the flow of how we manage money. And so, I don't want to get too excited here that we got a big up move coming in inflation, because I'm sure the commodities people think, oh yeah, boy, if you give us a nice jump in inflation here in just the next 2-3 years, we're going to make some money. To me, I think the whole thing's going to be a more long, drawn-out process. But we could kick it off with a jump at first, then settle down, calm down, and then something else later moves in. So all I can say is, I was already bullish looking for this kind of bottom, and now they're giving me the money printing, and I'm now even more confident. And now I'm seeing some big guys that, like I said, I didn't really expect them to turn this way so abruptly, but it's because they're looking at so much money out there.
Yep.
But again, for those on the commodity side looking for this higher inflation, well, you also got to get the economy back on its feet. And we got a ways to go. I mean, you got minus 5% GDP, but that doesn't occur very often, and it's like once a decade, and sometimes less frequent than that. And so we've got to get that back to at least 1% GDP to say, hey, we truly are growing the economy. And I wouldn't be surprised you won't see the average, how I want to put this, the average of the population really become comfortable with the economy until it's already record large. It has to fully recover and then some, and that could be a couple years away yet to get this economy back to record large. And then, if you have inflation, then I think people get even more excited. So at least bringing in gold, some people, because I don't trade or invest in gold myself, but I do follow it, and I've been asked by my followers here on my podcast to talk more of it. And boy, the model did a fantastic job in the last 30 days. It just said, buy it, it said higher, and it's just marched up really, really well. For a long-term target, I read someone else, a billionaire hedge fund trader, came out and said he's targeting $2,400. I read his monthly newsletter to his investors, and it was well done. They really did their research, and he really looked at Bitcoin. He looked at inflation-adjusted bonds and debt and gold, and he came up at $2,400, and that's close enough to what I've been thinking too. Again, for all I know, it could take many years to do that. But on the other hand, with all this money pumping, if Wall Street, if investors just get excited saying, hey, even if Rich Posson's right, it's going to take 20 years to get the highest inflation, I want gold now. Just get it bought. Yeah. And so I wouldn't rule out, gold could have a very impressive bull market without even having the inflation to back it up quite yet. And some of these big, Ray Dalio there with his $100 billion, that's how they're approaching this is, they're still in the stock market. But even when they're bullish, they're cautious, and they own gold, and they basically want diversification, and they're looking at this inflation thing. They think it's turning as well, Mm-hmm. So you're seeing people now had a kind of narrow focus where it might just be stocks and that's it. Now over time they've been adding the bonds because they were scared of this recession, and now they're kind of saying, well, how many bonds do I really want to own when the interest rate's at zero? Pretty soon, if it goes to -0, I'm going to be paying the person that sold me my bonds instead of me making money, right?
Right.
So you can just see they're looking at other things, and they're looking into the things like Bitcoin, and they're looking at definitely gold. And I think gold's probably got some upside for a while. The problem I've always found with gold is it could turn sideways for quite a while, and then you get your next up move, things like that. So the money's there to drive the inflation, but I think everybody's just got to realize you really need the economy back on its feet to really make that work, and we're not there yet.
Yep. Okay, so let's take a look at some of the weather events that we see around right now. So we're in most of the United States is in a pretty good hot dry spell right now. There get some rains and stuff in certain areas. You've got the desert locusts in northern Africa and southern Asia, India, and then you've got just this torrential rain pattern that we see in China right now that's affecting some of their key growing areas, especially when it comes to soybeans. And you got the Three Gorge Dam, which is like 3 meters from going over, and it's one of the largest dams in the world. And they're worried about it breaking and killing 500,000 people or something like that. So I guess you take a look at all these things going on. What's your thought now on looking at the commodity market and just some of the pressure we're seeing from weather and how that could drive prices? Yeah,
it's interesting, the developments here in just really the last 30 days, in my opinion, because for a few years now, one of my models called the C model has been saying you better look for crop problem 2021, 2024, high probability, and it seemed like, boy, the world just, you'd have a problem, yet world wound up growing a record amount. And so ending stocks were high, and you just couldn't seem to get away from the bearish information. But things have changed around the world where you can see that I'm not convinced that we have a crop problem this year in the U.S., but it wouldn't surprise me problems around the world, and I just wonder if this is all a hint of building towards that problem in 2021 to 2024, Mm-hmm. And currently I am targeting 2021 and 2023, so I'm trying to narrow the range down, but that could change it at any moment, and it could be 1 year, it could be 3 years, it could be 2 years, whatever fits within 4 years. It won't be 4 years of crop problems. I don't think I've ever noticed anything like that. But it does seem like we're building that way. So, but I kind of felt at first that for the traders in this country, they're not going to get too excited for a while. They've been burned too many times the past, ever since the 2012 drought, of any kind of a crop problem. So they've been cautious, and they are nervous of the global economies, the virus, the demand. They're very nervous, of course, over Hong Kong, China, U.S., and those issues. So they just don't want to get built up. These funds that have been bearish here, like in corn, huge amounts, record large or something like that. They aren't today probably because they backed off here in the recent days. But the thing is, they really wanted to play all the scenarios added together, saying, "Gosh, you've got to give me a seriously bullish move to get bullish." So all they're really doing is trying to get out of the way of any of these bounces off weather. And the same thing with the USDA report here a few days ago. Not Friday, but the one at the end of June on the acreage.
Yep.
And sure, they bought, but it was mostly short covering. You know, I mean, I'm sure some flipped along immediately, but as a group, they're not. And they're just trying to cover their shorts, trying to lose as little as possible, maybe make a little bit on a very short-term basis. And all they really want to do is just sell it at a higher price and start over because they just don't see much of a future for a very long time, and they just want to keep playing it. And but obviously, if we truly could get some serious weather here this summer, it might make a difference. But today I look at this hot and dry that's coming here over the next couple of weeks, and just tonight the market's down even lower from Friday's drop after the USDA report. So they're not that concerned yet. I think what they're saying is, well, gee, if we're going to get that hot a couple of weeks ago, why did we cool off this weekend? And it surprised me how well we cooled off to 82 the other night and 62 in the morning, you know. And if you can keep it at under 72 at night, that pretty much counters whatever you did during the day. At least the corn crop's going to do pretty good. And that brings me to my critical point temperature model, because my cycle model and the C model and some of these other models, the R model, that's all pre-growing season. It's not meant to study what is corn doing right today in the field. It's meant to warn you of what's coming weather-wise that can cause a problem. And these models literally label every single fluctuation in yield and production. Doesn't work in acreage, but it works fantastic in yield and production. Labels every single one of them, catalogs them. I know how many times during a decade, during a century, corn yield is going to move up and down. It's like it's got its own formula, its own code, and it's just amazing to me. Most people miss it. Most of the analysts, they don't see it. So with that, I can then try to figure out when is you're going to get the most important impact out of that, right? And that's what's coming up here in a few years. But this critical point temperature model is a model used during the growing season, and it looks at just June. It looks at June, July, August temperatures, and it's just an average 24-hour temperature. And I've discovered a certain temperature that when it goes even 0.2 of a degree above that temperature, yield falls apart. And it can be severe. It can be a few bushel an acre, but it tells you temperature is more important than precipitation. So when you see that happen with temperature, then you got to start paying more attention to precipitation, because that can add to it or help limit the decline in the yield. And this model has worked 100% of the time since 2000. So very pleased to how that works. Now, here's sort of a flaw or a drawback on it. It uses all the way through the end of August for temperature. Well, the market's not going to wait that long to figure out whether you got a good crop or not. And so you're kind of forced, starting here at mid-July, I'm going to start saying, okay, what's the 2-week forecast? And then I'm going to gamble on another 2 or 4 weeks that we're going to have that kind of trend. I'm going to look at what it does normally over the past 10 years or something like that, and get a handle on how is that temperature going for summer. And so you never get the exact number until summer is over, unfortunately. Like I say, you gotta take a chance on doing something early now. So I fully get why most people would say, okay, I'll keep an eye on that model, but it's more important to watch crop condition. It's more important to just watch the weather news. Yes, you got to do those things. But this year, I'm not going to follow my USDA temperature model, which last year was like in 0.2 of a bushel USDA. I mean, it pretty much nailed it. But this year, I'm so bogged down with all this economy stuff, macro stuff, the climate stuff, and I'm preparing for this weather problem in the next few years. And then I was hopeful some of my affiliates were going to run the model. Well, they're working on the same thing I am. What's up with this inflation? What's up with the economy and virus? And so we've just decided, you know what, if we look how we normally trade a market, we don't need to predict USDA. We're fine. We're just waiting on USDA numbers because we're probably already going to trade it correctly going into the report anyway, so just go with it, right? So I won't be following that, but I'll certainly be paying attention, watching Twitter of what others are coming up with. I won't be following the crop condition model either. I think some have a little better model than I on that. and I'll be following what days have. But I will keep track of how these average temperatures are going. And it really does boil down to not just how hot it is during the day, but does it cool down enough so that the corn can recover during the night. It actually does counter these hot temps. And granted, the latest hybrids can take it a little more in heat, but I got to warn you, this research going back ever since 1865 on corn yield versus prices versus all this modeling. If it's time for a 20% drop in yield, the best you can hope for technology is saving your crop is you're going to drop only 18% yield, okay? It does not work as well as advertised. But if its yield's only going to drop 1%, maybe 2%, it is possible technology can counter that entire amount and you see yield was unchanged for that year. Where technology works the best is when we get good weather, it can make a record yield better than you would expect from good weather. And so, boy, if you get the perfect weather, who knows how high yield could be, you know?
Right. Yep.
So that's how you want to approach technology with this is don't buy into the idea it's going to protect us from a drought. If we're going to have a drought, that yield's going down. That's all there is to it. So at any rate, yeah, I'm watching weather like everybody else. And yeah, late last week I got excited off the temperature forecast and, oh, boy, they're going to hold this price up. And I said if it goes over a certain price level, we better be bullish because my model had just turned short-term bearish ahead of the report. And son of a gun, it came within 2 cents or something like that. Rolled over, didn't give the true signal. I personally felt bullish anyways. And so my model was actually a little smarter than myself late last week. And so what's occurring right now tonight with the lower prices, the model was already saying, well, that's what you should have done. And I think the problem is people don't trust this weather, which may be a sign in the next few years, if they keep that attitude, that's where your big bullish surprise is going to come in, as they were bullish too long and got the bad crop problem, and then prices just soar, you know. Yep. People have been trained, you know, the nature and yields and the prices have trained them for 5 to 7 years now, that maybe we'll never have a crop problem again. Well, if you really study your history, you know that's not the case. You know, it's coming, but I'm not convinced it's coming to this year, and I certainly have some farmer friends who are saying, oh, we got to have it, please, it's got to have it, and some of them are, they think it is coming, but I'm not seeing the evidence there yet, and you can see the market's not feeling that way yet. And even though, yeah, China bought a bunch of corn from us, and they bought the beans, you can just see they're just trying to keep up with that phase one deal, and I don't think they're really doing anything extra, and I think the smart market is currently smart enough to do that. And so, you know, the bottom line is the market is really saying, the only way to get bulled up is you got to give me some serious proof. Otherwise, I'm selling rallies all the time is what the market is thinking. And someday that's going to trap them. They'll be wrong for that attitude, but right today they're probably right. My long-term business cycle in corn, wheat, soybeans, especially corn and soybeans, really shouldn't bottom to harvest. But I will say, you look over there at China, I mean, that's some massive flooding, and there's even stories that dam ever breaks, they won't be building another dam for a long time. Everybody's going to be very cautious, rethink, restudy. To me, where that area is with that river, to me, that's not such a big thing as for grains, really, and with that dam. But like Casey, you and I talked before the show here, you know, there's discussion there that, no, some of the soybeans are wet. And I don't think they're wet in the real northern areas where it's really a bit more corn, but also soybeans. So I don't know where to go. That's something to monitor, where they could have to import more. And my gosh, they've already been taking, I mean, Brazil has just been pumping the beans to China, something wicked here. Yeah. How much more they can do. And, you know, seasonally, once we harvest our crop, normally the world says, okay, send the business to the U.S., and I think China would do that. But can it really make these prices bold up? And I'll just go with the old rule of thumb I've used for 30 years now, and that is, at least for the U.S. markets, they only understand one thing to be really bold up. It's got to be hot and dry. And so if it's flooding, they'll be bullish, but they won't be that bullish, you know. And I just look at everything going on with the economy, the virus, this trade war issue. It just seems like we got limited upside, even if it becomes bullish, at least for this year. But I will say, even though my model wants to be bearish into harvest, which implies we ought to have still lower prices, the model is saying it could just go sideways now. We're probably building a floor price. And that USDA report at the end of June there with acreage woke up the market, made it more sensitive to bad weather. And I think it's a bit of evidence of trying to build a floor price. And now you see what's going on in China and in Africa and here. I don't want to be very bearish here. I'm still going to kick out sell signals because I have to anyways. That's what I do. And when we kick out another sell signal grains, people can use it or they can leave it. And I must say, when I see prices getting down towards the low end of the range for the year, the past few years, I don't like being locked in. So I want to be flexible. I'll sell it because, it might drop a lot more than you think and come back so slowly your business gets hurt. If everything's negative and you get that next sell signal, I feel like you got to do something, right? But should you be selling huge amounts when you get down here and stir up the lows? That's where I say I want to be flexible. I want to be able to get out of it. And that's where hedging is probably better than getting locked in on a contract, unless you can buy out of that contract.
Yep.
So to me, that's my message on the risk management side on agriculture is, regardless if you're a farmer or if you're some kind of terminal elevator and sitting on grain wondering, if these prices should be hedged. I think you still need to take signals. I think you still need to take care of near-term risk. But I think it's just getting low enough where we have to think about a floor price and have to think about someday all the bearish news we've had all these years. It's obvious the big news someday is actually going to be bullish, not bearish.
Yep. All right. So the inflation that we're seeing happening, that you're talking about coming, those kind of things, that will have effect on the value of the dollar. And as the value of the dollar starts to come down a little bit or gets weaker, and we start seeing maybe some more demand internationally for grains out of the U.S., do you really see that happening to where the dollar weakens enough that we become ultra competitive on the open market for exports?
I do, but I don't know. I've been working extra hard on the dollar in these past couple of weeks. And, I'm missing some data that I collected many years ago and did some super cycle research on it. And I still got to dig it up. I filed it somewhere. I move around the country too much. I had three homes at one time. I'm jumping around between those homes, and it feels like there's a super cycle thing going on for the next 20 years that's actually going to keep the dollar. I want to say the super cycle will be bearish, but the problem is the dollar can't be bearish that long. Nothing works that way. Currencies are based in a very super long-term sideways range. It kind of looks like basis on corn or soybeans or something. And so probably the correct thing to say is there's a chance over the next 20 years that there's a greater headwind to the dollar so that you just don't get super high values in the dollar. So I could see how that can help with this. I could see how that goes along with the inflation story for the next 20 years. But I got to do a lot more work on that before I get really pushing the whole super cycle ideal on the dollar. But what I can tell you on major long-term to minor long-term trends and related business cycles is I really think the dollar should be at least lower than where we are today on around 2022 to 2024. And I would like to think we just put in a top in the dollar, but if we did, it's my third try at it because I started, I think, mid last year and had two strikes against me, and now we're up for the third, and it looks like it could stick, that it's going to win. So there is a chance for dollar set back now all the way into 2022 to 2024, but when I say that, keep in mind, if it were to drop rather quickly, it's probably going to rebound some, move sideways a lot. The dollar spends most of its time actually going sideways. And so it could be a very slow process of grinding, working lower. So I don't want to get people all bowled up on the commodities saying, well, Rich Posson just said the dollar's going down. So it's a really more of a process. And the problem is there's an alternate forecast saying you may have one more year of the dollar being stable to higher, and then it's going to go lower. And right at the moment, the only way I'm coming up with higher is we must have some more serious economic issues here and maybe more global issues where people want to move their dollars into the U.S. even to try to support that. So maybe we get some kind of panic there for some reason that they're going to use that as their safe haven and prop it up. But for the moment, I got my fingers crossed because I'm ready for some support in commodities, and I'd like to see our economy shift a little better because, frankly, I think a little inflation and a little better commodities actually helps the middle class and poor. It will hurt the rich on the inflation side. But not enough to to be a major issue, I don't think. So I want to be a bear here in the dollar, but I'm not entirely convinced. There could be something that goes wrong in the next 12 months, puts it right back up. There could be a gigantic spike off some shocking news here. Something blows up with China, U.S., gets far more serious than the trade war. There's all kinds of things I suppose that could go wrong. But right at the moment, I'm rather optimistic of trying to be a bear here in the U.S. dollar. And again, I think that, I don't know if it supports inflation or whether it's just a sign the dollar trader is willing to jump on board this inflation and just says, well, we got to have lower dollar. You have to be careful of that, because normally when inflation is going higher, interest rates are also going higher. Well, higher interest rates should actually support the dollar. So you're going to get, that's why I think you'll see more of a process. You'll get maybe a year or two lower dollar, then for some reason it's got to come up a year or two, and it may be because it refocuses on higher interest rates instead of higher inflation. And then another year or two, it's back to refocusing on, higher inflation, And I can tell you, dollar traders, even though they really work on interest rates and the economy, they definitely watch commodities. They watch anything and everything that can influence interest rates, economy, dollar. So if they seriously think there's a move up in higher commodities, they'll actually start buying the dollar off of that. Now, that doesn't mean they can't be countered by something else, but if you can just see these things trying to align here to create something where things can improve. And I guess what fascinates me is if we could just get the dollar down somewhat during that period of 2021 to 2024, and if we can get this economy to bottom by no later than next year, so that the economy is actually doing fairly well in 2022 to 2024, and then you bring in the crop problem I'm talking about, to me that just gives you more upside, right? And could make it far more interesting for the bulls. That's definitely. So these are some of the things I'm watching. It's kind of like a chess game, and you can come up with like 100 different bullish scenarios. It drives you nuts sometimes, and that's what I like with my core modeling. It kind of simplifies it, saying just go with the general idea. Okay, we're going to get the checkmate, and it doesn't matter necessarily how we get there. So that's how I'm approaching it. But I want to favor the dollar, and I got some very interesting people that are totally on the opposite side that think they think looking out 10 years, the dollar's coming down and it could actually crash. It could get trashed, is what they say. But the interesting thing is they're kind of bullish for a few years on the dollar, and I don't care for what they're saying, and I have to keep checking base with them to make sure I understand it. But I can't go there. I think the dollar is going to be down by 2022. The question is, does it got to go up one more at a time and then down? And we don't need a dramatically lower dollar. If you can get me 92 in the U.S. dollar index, I think we've got better exports. But here again, we're hung up on this idea we've got to fix the economy, not only in this country, but in other countries. So, but I think it's coming. I think the world, even though some countries don't necessarily follow our business cycles here, most of the world through globalization is kind of coming to the same line of cycles. So I got a feeling next year, if it doesn't bottom this year, I think the whole world can bottom by next year. And if you could just pick up the global economy, bring the dollar down, and the interesting thing is I still say a lower dollar actually helps the rest of the world, and I think it helps the middle class and poor. And I realize sometimes the dollar has to be up in order to help some countries, even in the commodity industry. But boy, I go back 100 years worth of history. Best I can tell, there's been quite a few times you had a lower dollar, and you would think, all right, we're beating Brazil, and yet you would look at Brazil and they're saying, well, gee whiz, Brazil's selling even more. But it also turned out we were selling even more. So it still worked for us, It's just an interesting scenario. And again, I think it just boils down to the global economy kind of coming together.
Yeah.
So I'm really fascinated what's going to happen in the next few years here. And we just, on the commodity side, agriculture side, and I think the stock market will still do well on inflation. I realize you get it high enough, long enough, then you got to worry about the stock market. But I got a feeling we're going to hit an interesting window here where we can make money in several different things, and the middle class is going to be breathing easier, doing a bit better and get some better paychecks and incentive bonus and things like that. But gee whiz, we got to get through this virus, and I understand people's personal freedom and everything, but I wish they'd wear masks and try to make sure this thing doesn't blow up much more on this virus thing, because it feels like the Fed has pumped enough money and we put some floors here in the economy, in the stock market, maybe even the bond market. Now we just need to get through this darn virus and get people back to work, and I think it's going to click through.
Yep.
Hopefully that makes some sense.
No, yeah. Makes good sense, man. So that's all good stuff, Rich. Talk about your podcast and where people can find that.
Okay, it's called Critical Point Podcast. If you're just searching on the internet, just put in Critical Point and Rich Posson. But the main website to go to, even though it's on Apple, Google, many others, just go to criticalpoint.podbean.com, and that's bean as in soybean. criticalpoint.podbean.com, and then you can find me on Twitter at Rich_Posson. And so take a look at that, and you can always direct message me on Twitter if you have any problems with podcasts or anything like that. But it's going pretty smooth. They put out several podcasts a week. Some of them free, some are under a subscription. But we look at grains and oil seeds, and then sometimes a little on the livestock and dairy, but more likely to switch over to some of the softs like cocoa, sugar, cotton. But then we get into economy, a lot on the economy, climate, and what's coming up for weather and crops. And then stock market is literally updated daily just because it's been so volatile, and I give something anywhere from the short term all the way to the very long term in the stock market, and I invest my own money using this model, and do it also from short term to long term. So I know it works because I got my own money in it, and it can't be right all the time, but I've come to the conclusion I'm better than most of them with this model. And it's been many years building it, and the model has discovered that 50% of what goes on in the market really doesn't relate to fundamentals as we know it, but it's actually still fundamental. And what it is the people behind the scenes, mostly like in commodities, it's the demand side of things. When you look at the corn market, 50% of corn demand, domestic corn demand, is feed food. And if you look at that, there's very little reporting on what's going on. And there's no requirements, it's infrequent, and everybody's basically guessing. And what I've done through this modeling is I've discovered 12 major groups of market participants that they're doing the fundamental analysis, they're doing technical and charting, and they got their computers. But the thing is, some of them are actually commercials using those commodities, some of them are speculators involved in those commodities, and it's picking up on those kind of people. People are more important than what's in the soybean bin. If your soybean bin's half empty, if they don't want to pay you for it, price still doesn't have to go up. If it's half empty and they're scared to death of getting that from you, they're going to pay you a huge amount. I mean, it's that delicate of a situation. And this modeling can explain nearly 100% of all price fluctuation during the year. So very proud of it. Worked that hard for 20-some years building this kind of modeling, and it's the main thing. Even though I love to get out the fundamentals and news and information, compare it, and talk about it, that what I call ex-fundamental, knowing what that demand side is doing, that very few people know what they're doing. And I've worked for some of the commercials, so I've been behind the scenes so I can see that my original modeling was correct. I'm tapping in those kind of people running the show.
Yep.
So give it a chance, check it out. I think people, I think everyone will like it.
Yep. Well, good stuff, Rich. Thanks for being on the podcast, man.
All right, thank you.
Great. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you find this podcast when I post it. Also, check out movingironllc.com for all the latest information about Moving Iron podcast, as well as the Moving Iron Summit coming up here September 1 through 3 in Nashville, Tennessee. Still have time to get signed up for that. So if you're interested in doing that, shoot me an email at movingironpodcast@movingironpodcast.com. Also, check out the Global Ag Network and the great podcasters out there as well. I guess with that, I am Casey Seymour with Rich Posson. Let's go move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.